In August 2023, Zoo Digital told investors about a fourth successive year of double-digit revenue growth, margin improvement, and record pre-tax profitability. To find out more about the company, I'm joined by Chief Executive Stuart Green and Phil Blundell, the Chief Financial Officer. So Stuart, before we put those numbers into context, what is it that the company does?
Well, we're a provider to the entertainment industry. We provide services to large streaming companies and other organizations that create content such as feature films and TV series. And the work that we do is to take those programs once they're finished and do everything that's necessary so that they can be delivered primarily through streaming services to consumers. And that entails some technical things to make sure that they work properly, they play smoothly and so on. There are no glitches. But also, importantly, it involves adapting them into different languages, which of course you do using subtitles and by dubbing the soundtrack. And we do that for 80 languages.
So in terms of the customer base, according to a very well-known radio program this morning, it was talking about Hollywood strikes, and in an interview with BAFTA, I wasn't aware that these strikes are causing the industry potentially hundreds of millions of dollars daily. So how is that impacting your business model?
Yes, it's a real, these strikes are a real disruption to the US, particularly the US industry. In May, the screenwriters came out on strike and they were joined a couple of weeks ago or so by the actors. And what that means is that it's pretty much all production of new programs out of the US is on hold. And of course, a lot of the work that we do is to take finished programs, mostly new original TV series and films, and do the work to get those programs onto the streaming services. So it certainly impacts us, but it has very wide repercussions right across the industry. As I say, it's just the US. It's just the US unions that have taken this action. So productions are still continuing elsewhere. But it's, even though we see more and more non-English original programs on our screens through streaming services and elsewhere, it's still the case that certainly for English-speaking audiences, the majority of the content comes from English-speaking countries, particularly from the US. So it has a very wide implication right across the industry, and it is painful for us right now because, as I say, the supply of new programs coming to us that we would normally work on has come to a temporary halt. But it is temporary, and it will resume once these differences have been resolved.
So is that what you meant in your statement in today's regulatory statement? There was a very pointed message about the frustration of disruption. Are you talking about what's going on in Hollywood? And what did you mean? Surely you are a disruptor, and disruption is a good thing.
That's an interesting question. Yes, that is true, and we are a disruptor because we're a tech-enabled business, and the way we do what we do is very different from the way in which others in our industry do it. We have a large R&D team, and we produce proprietary software that makes us very efficient and very scalable in what we do. But the disruption in the industry is actually coming from two places: the strikes, which we've already discussed, but also this is a kind of pivotal time for streaming services. In 2022, 2022 marked the first time when in the US, consumers were watching more content through streaming than they were through linear TV. And that's just a continuation of a trend that's been ongoing for a while and will continue. And of course, with it comes some challenges for media companies, because linear TV has been a huge source of revenue and cash, both in the form of through advertising routes and through licensing income, and just through the fees that are paid by, for example, cable operators to content owners and so on. So with that falling away, it is being replaced by streaming. Yet for most of these organizations that are offering direct-to-consumer streaming platforms, they're not yet profitable. and they need to get to the point of profitability sooner. With everything else that's going on in the world, they are all looking to accelerate that route to profitability. And that's given rise to actually some more disruption in the form of reorganizations and cost cutting that's taken place within our customer organizations. And that again has the effect of delaying work and postponing projects. And we've seen quite a lot of that actually that commenced in February of this year and is still ongoing. So there's actually quite a lot of disruption in the broader streaming industry because of the need to transition to business models that make sense in this new world of streaming compared with linear TV of the past. And in this regard, as these things change, as a disruptor ourselves, Zoo actually is in prime position to be able to capitalize on new opportunities once we get through to the other side of this short-term disruption.
Okay, and you did describe that short-term disruption as painful. So, Phil, are we going to see elements of that pain transition into the numbers, or are you hopeful that we could, in a year's time, be talking about a fifth successive year of double-digit growth?
I think it's pretty unlikely that we will grow the business in FY24. Just for those who don't know us, our year end is March, so we're nearly halfway through that financial year. What investors will see, though, is that the second half will show that we are significantly up on the second half of FY23, and therefore the trend is resuming. So the way to look at it is we've had sort of this 6 months of pain, but we'll come out of it stronger, and we'll resume our double-digit growth.
Phil, I'm just wondering, though, whether the trend of the company is going to be one of acquisition, because in April you had an oversubscribed placing. Well done. You raised £12.5 million gross to fund the acquisition of a partner company in Japan. But how are those discussions going? And in the meantime, what is that money doing? Is it in a high interest account?
Yes. So 2 points. The first one is that we finished last year, March 23, with $12 million in the bank anyway. We have no debt. So this disruption at the moment, we're able to fund from that pot of money. The money we raised, we've separated. It is in a, well, high interest account, one way of putting it, but it is earning us interest. The discussions are going well. We did say it wouldn't close until September anyway. But the added uncertainty has meant that we have gone back to the target company and said, well, given the current market conditions, actually, it's only fair we pay less. And they are looking into that and whether they are prepared to accept a lower price for the business, because they're hurting just as much as the rest of us.
Is that a deal breaker, though, if they don't accept your lower offer? Because that was quite a political move you made there.
Well, that offer was made a few weeks ago, and they haven't rejected it. But Japan is a market that moves slowly, and the dialogue is still going on. We have completed the legal documents and parked them so that we're ready to close when they agree to a revised price, which I'm sure they will, and B, we can see the light at the end of the tunnel in terms of the disruption. So watch this space.
Okay, so Japan is proceeding with great thoughtfulness. So what is the acquisition strategy then, Stuart? Is it that region that you're targeting? Is that where the growth will come from?
It's a good question, and it's actually something that investors are a little bit curious about in the way in which we're operating, because we have essentially cloud-based software that we've developed that means that, in theory, we don't need to have physical offices in locations around the world, because we can interact with people over the internet using, very effectively using our platforms. But the reality is that there are some countries where, for strategic reasons, it makes sense to have a point of presence, and Japan is certainly one of those locations. That arises either because a particular country or region is an important source of original programming, or because that particular country is a high consumer of premium entertainment content. So actually, Japan falls into both of those categories. I mean, you may know that Japan actually is the source of the greatest proportion of content, non-English content that's consumed on Netflix, for example, primarily due to anime, which is obviously a very specific and popular genre. So it's Japan is an important market for sourcing original programming, but also it is the second largest territory in Asia after China, which is clearly important to our customers, and therefore, they need to, we need to align ourselves with their needs and make sure that we can offer them, excellent services in Japanese. Looking at the world, more widely, again, there are certain other countries that have where there's a similar strategic rationale to invest ourselves, as in the case of Japan. But generally, having a point of presence in certain regions puts us physically close to the talent that we need to do what we do, because a huge part of the work that we perform on behalf of our customers is actually fulfilled using freelancers. These freelancers are very specialist translators, and they're also actors, and they are directors and various other skill sets. So we engage with them on a freelance basis, so we only pay them for the projects that they work on for us. So having points of presence around the world puts us in a position where we can interact with those people in the same languages and in the same time zone. And consequently, we do have a program of establishing in key locations a point of presence for Zoo around the world.
So finally, gentlemen, when you look at your share price performance, what do you think is the trigger? Is it market sentiment, regulatory statements such as today's, your communication strategy overall, sectoral, macroeconomic trends, or technical analysis?
Do you want to say that one?
Who knows? I mean, we're obviously, small caps are in a bear market, so any sort of hint of weakness is punished quite severely. So I think that's certainly weighed on Zoo. The forecasts in the market are lower than they were 6 months ago. But personally, we feel that that's been overdone. And
it's time for a correction. But today's statement was one that was joyful. And although you acknowledge that there's frustration, hopefully there will be a solution where the industry is concerned. Stuart Green, Chief Executive, Phil Blundell, the Chief Financial Officer of Zoo Digital. Thank you very much indeed.
Thank you.